How do you do, ladies and gentlemen? I'm your host, Seth Julian, and we are going to discuss today the 5 classes of assets that exist in the capital markets. They're diverse, they're interesting in their own rights, and they all have their own characteristics. So let's start with the most obvious, the most well-known asset class in the category of capital markets assets: stocks. Stocks are tiny fractions of ownership in corporations. That's all there is to it. My company has been in business, and on my books, I think the company's worth $1 million. Worth, that means not what it made, but on paper it's worth, if I sell all the assets, the office equipment and the computers and my knowledge and my inventory, etc., it's worth $1 million. I need some more money. I'd like to grow, but I don't have that much in profit. I'm getting into some accounting terms. I don't want to overburden us with accounting, but you need to know how money comes about in a stock market, stock share ownership. The company then goes to the public market and says, we want to sell some of ourselves to you. You can buy a share, and that's what they call them, shares in stock. So if we think the company's worth $1 million rather, we're going to sell 20% of it for $200,000. We're selling 1,000 shares, each share $100. That's the long and the short of it. Now, if people look at this and say, well, they're selling shares at $100 in this company, but I think their value is not $1 million, I think their value is $3 million. I may see an advantage there. I may buy that share. And that's not only good for, that not only applies to initial public offerings, that applies to constant offerings. Some of the corporations that are available to you on our platform have been in business for 120 years. General Electric was on the Dow Jones Industrial Average for the better part of 100 years. You buy a small percentage of the company. If the company's value, its market value, its stock market value, its share price goes up, you benefit if you bought it. If the company decides to share its profits with its stock owners and gives out what are called dividends, you share in that as well. So there's a dividend benefit and a capital gains benefit when the stock rises up. That's what the stock market is about. There are stock markets all over the world. The biggest, of course, by market capitalization is the granddaddy of them all, the New York Stock Exchange. Not the granddaddy, actually. Capitalism gets its real start in Holland in the 16th century, but that's another story. The biggest stock market today by volume is the New York Stock Exchange, but it's not dwarfed in any, it doesn't dwarf by any stretch the Tokyo, the Shanghai, Wellington, Sydney, all of the Mumbai, all of the great markets in the world is where corporations go to sell themselves, to raise capital. Now, the second class of assets is called stock market indices, and they're a close relative of stocks. It's right there in the name, stock market indices. What's an index? An index is a mathematical device where you take a bundle of things and you sum up their total, and you say at a certain point in time that sum equals 0. If the value of that bundle of things gets more valuable, the index goes up in a direct correlation of 1 to 1. An index, 100%. Goes up 100%, it doubles. Same if it falls. If it loses value, that index, that value, index value goes down. The advantage of the stock market indices is that instead of doing your research on Tesla, on Rheinmetall, on some particular stock, and what their assets are and how solvent they are and what their long-term debt structure is and how much retained earnings they have. In other words, how valuable is the stock relative to its price, which is the essential stock market consideration. You dispense with that with index assets, and you buy the whole market. All of the indices are not the entire market, but the biggest, most obvious, the most important, if you will, stocks in those markets. So you have the Standard & Poor's 500, the 500 largest stocks by market capitalization, and that's just a fancy word that means if you took all these stocks that are available in the market, that's what, and you multiplied them by their market price, that's the market capitalization of the firm. It takes all of those together and makes an index out of them. So you've got the NASDAQ, the S&P 500, the Dow Jones, the DAX, the FTSE 500, FTSE 100, excuse me, the Milan, the Iberdrola, the Spain, everywhere. Everywhere there are indices. And it's a handy, quick way to take a position in the economy writ large. Stock indices. The next category we're going to talk about is the oldest category, called bonds. Bonds, just as the word says, is a instrument of trust. Bond. Ian Fleming didn't give his character the name James Bond for nothing. Bond means trust. My word is my bond. A bond is a promise. What's it a promise to do? To repay what you lent me. If I'm a corporation, and I don't really want to sell myself on the stock exchange, I want to retain as much control as I can, but I still need money to grow, and I'm profitable. I will go to the public and borrow money from them, and return the money in a fixed date in the future called the maturity date of the bond, a payment called interest every 6 months, every 1 month. It depends on the terms of the bond. They're highly flexible. Bonds are referred to as little money machines. You buy the bond, and it keeps spitting back a little money all the time until the end of its period, its maturity period, and you get the whole principal back. Yes, there are risks here. The risks are that the principal, the inflation rate in the general economy exceeds the interest you're receiving on the bond. But that's a subject for advanced bond trading. Suffice to say, however, many people, particularly the older crowd, prefer the bond market than the stock market, principally because it's less volatile and more stable. The bond market. In fact, I'll give you one last example of the bond market. When analyzing capital expenditures, a businesswoman has to say, well, I'm going to spend $1 million in order to make what I think might be $1,800,000 in 2 years. Part of that analysis is to say, well, what would happen if I took that $1 million and put it in the safest non-risk investment I could possibly do? That generally is the U.S. bond, the 10-year bond. That's the measure of stability. So it's part of the overall calculus in the entire economic and financial world. That's the bond market. The fourth category is the largest, by a huge margin, of all the capital markets. The foreign exchange market. Just to give you an idea, we had talked about the capital markets, the stock market in New York being the largest stock market in the world, and it is. I don't know exactly, but it's about $500 billion a day, something like that. I'm not sure about that. But what I am sure about is this. Now it's slightly more than 5 times the value of all the stock markets in the world. The total value of all of their market capitalization, 5 times that number is traded in the foreign exchange markets every day. Enough said. It's the world's largest market by a huge margin, by a factor of order of magnitude, I believe, of 5. And how can it be so big? What's so special about this market? Foreign exchange market is an old market, and all it means is money changing. It's a fancy word for money changing. Those of you who've been on vacation in foreign lands know that you have to take your money that you came with and buy the money that you're transacting in the location you're at. Foreign exchange. Same holds true if you're Avis and you have to buy 10,000 Toyotas from Toyota Auto Manufacturing in Kobe. They're going to say to you, okay, we took the order. We'll be able to deliver them on the boat in 30 days. You'll have 10,000 cars. You're going to owe us 100 million yen in 30 days. Get ready. Avis says to its bank, okay, we're going to have a $100 million yen debt in 30 days. Buy the $100 million today with today's dollars, and then we know that we're covered for that debt. We paid it, we covered it, we don't have to worry about it. Goes up, the yen goes weak, the yen goes strong, we don't care. This is the foreign exchange market. And this, by the way, what I'm about to say is true for all markets. We as speculators function as the grease in the gears of economics and finance. We take positions on these assets in order to profit. We speculate. But Avis isn't speculating. They don't want to speculate. They want the opposite of speculation. They want to hedge their risk. They don't want to have to owe pay for 10,000 vehicles in Japan in a month and suddenly realize that they owe 20% more than they owed when they may close the deal. They don't want that. They say to themselves, we want to lock in our price. If somebody in Chicago can make money from this, good luck to them. If that same idiot loses money on this, too bad for them. We're covered. And that holds true for agricultural products, commodities, which we'll get to in a moment. That's the fourth class. So that's the foreign exchange market. The fourth class, of course, is commodities. And commodities are those underlying, they're the fundamental raw material inputs into the industrial society. Copper, coal, steel, wheat, corn, coffee, sugar, tea, cocoa, silver, gold, platinum. Commodities. They're the essential raw material elements in the industrial society. And commodities are a fascinating class because they are designed to be highly leveraged and to encourage profit for the speculators. Because if they didn't do that, we would have a lot less oil and a lot less wheat and a lot less cotton and a lot less sugar and a lot less cocoa and a lot less wealth and productivity in our civilization if it weren't for the ability of farmers to say, I'm going to plant right now. This stuff in the field isn't going to be worth anything for 6 months. But I want to get my money today. I will go I will go short. I will sell what's in the ground that doesn't really exist into the market for somebody to buy in New York, Chicago, Hong Kong, Taiwan, wherever they are. I'll get my price. I go to sleep comfortably. I know my profit margin is locked in. If the person buying the other side of what's in the ground profits, good luck to her. If she loses, I don't care. So, and it doesn't have to go up or down very much for those people to realize huge movements in the commodity prices. So that's commodities. And the final category, of course, is cryptocurrencies, our newest and youngest category of capital assets. Cryptocurrencies, as you may be aware, came into existence in 2010 with the famous white paper by Satoshi Nakamoto, who posited the existence of the blockchain. Blockchain technology has given us the Bitcoin among 1,000 other coins, but there are only about this many coins that have any real future right now. These coins are speculative commodity type assets. They're not yet currencies. They're called cryptocurrencies, but they're a long way from currencies. But this is the point I want to leave you with. They're not just currencies. That is a very poorly chosen, very inappropriate name for what, in my opinion, and the opinion of many others, is a revolution in socioeconomic relationships. The blockchain is already started to facilitate less fraud on insurance claims. Which, by the way, insurance claims are very expensive for us. Well-known fact that 20% of insurance claims are fake. Who pays for that? You and me. We can get rid of those. And all the lawyers it takes to process them, and all the judges it takes to adjudicate them. Reduced. It's safer. It's faster. It's more efficient. It's cheaper. The blockchain is here to stay. It's got a lot of evolution to go. There's a lot of money to be made. Our advice on this subject is quite clear. Take a small amount of your portfolio, put it into these assets, and forget about them. They're way too volatile to trade, but they have a huge upside potential. And so, ladies and gentlemen, with that, we end our presentation of the 5 classes of capital assets in the capital markets. I'm your host, Seth Julian, wishing you all, ladies and gentlemen, the ability to trade with confidence. Bye-bye.